Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir. How are you going?
Pretty good. Yourself?
Very good.
Interesting conversation today, all about reading the small print.
Absolutely. One of the things, Martin, you and I have spoken about over the last couple of years, particularly when it came to deposit accounts and bail-in, is the importance of reading your terms and conditions with the bank products that you have. And so we've been quite religious about that, and we've shown on the issue of bail-in specific clauses that customers needed to be aware of, and people watching our show. So we had a situation last week where we had Members Equity Bank, or known colloquially as ME Bank. They reduced the redraw facility limits as to how much money people could withdraw from the mortgages of advance payments, and this caused a huge problem in the press and in terms of public relations. And a lot of customers were upset, and a lot of customers were unaware of the bank's ability to do this. And so I think it's worthwhile to have a discussion about this today, because one is what the bank did was actually perfectly legal under the contract. And the issue is not that the bank acted illegally or immorally. They just customers didn't actually read the contract. And two, I think there's been a bit of confusion in the mainstream media talking about. There's been the use of the term confiscation. Some people on YouTube have talked about the bail-in of mortgage accounts. I think these are mischaracterizations of what's happened, and I think it's worthwhile to cover this topic, because one of the questions I've had quite often when people called me up or contacted me last year, I know you've had the same question of is if you have a mortgage and you have additional money put aside, what should you do with that money? Should you put it on the mortgage and use a redraw facility? Should you use a mortgage offset account? You and I have slightly different ideas about this, but whether you go either or, both of them carry risks, and I think it's worthwhile to discuss those risks today.
Yes, I think it's very important that we do. And it's worth saying, I think, John, that if you actually take a mortgage or even a deposit account from a bank, they give you a lot of verbiage to read, right? And it's a bit like those long contracts for all the internet companies and online services. Nobody, hardly ever reads them, but everybody should, because even in simple contracts, there are often weasel clauses and weasel words that basically are written to the benefit of the company rather than the benefit of the customer. And so everyone must understand these terms and conditions are drawn up by lawyers on behalf of the providers of services to bias the privilege and outcome to them rather than to the average customer. And of course, it's not until something goes wrong that you then actually try to read the terms and conditions and try and understand what's happened. So there's a really important warning there. And then specifically with regard to the structure of mortgages and offset accounts and things, there are some complications that people don't understand. And my experience talking to mortgage brokers is that even mortgage brokers don't necessarily get it right either. So again, it's important to do the homework and understand what's going on.
That sounds a little bit scary, Martin. If mortgage brokers don't actually understand the products that they're trying to sell to customers.
Remember that a mortgage broker is there to get a deal. And whilst they have responsible lending obligations, my own view is that those responsible lending obligations are relatively benign. And in some cases, they won't necessarily have a full understanding of the different options and choices that you may have, and will point you in a particular direction because that's what they understand, that's what they've always done. So, you always have to be very careful. When you take advice from somebody who's claiming to be an expert, just to kick the tires and make sure that they are really giving you best advice. Remember that they should be acting for your best interests. And that's recently been clarified under the law. But in some cases, I have to say mortgage brokers don't necessarily do a very good job with regard to their clients, in my view.
Fair enough. So why don't we just put the image on the screen of this article from the Sydney Morning Herald that was published on Saturday by Adele Ferguson, so the 2nd of May. So basically, what happened last week was that ME Bank reduced the limit as to how much customers can redraw money from their mortgage, and that caught certain people unaware because they had put some money on their mortgage, thinking that if a rainy day came, they could take that money out whenever they wanted, and it was going to be unfettered. And basically, the bank put a stop to that. And according to the article that Adele Ferguson wrote, was that the reductions in the limit of the ability to redraw was anywhere between 10 to 50% in terms of customers. So that obviously caught a lot of people unaware, because during this lockdown, a lot of households need quite a bit of cash to get them through, particularly if they're facing unemployment or if their cash flow or income has been disrupted. And so a number of customers have gone to the press, and the press have made a song and dance about this. Quite a few of the shareholders of ME Bank, like industry super funds, they've been complaining as well. And I heard one of the deputy chairs of APRA saying that APRA has gone, in the capacity as the regulator, have gone to ME Bank to actually understand, well, why have they gone about doing this? Now, the bank itself, and we'll put this quote up. So this comes from the head of the network distribution. The bank's defense is that, quote, no money has been removed from customer accounts. And so the bank has said that the way this is being described in the press has been very inaccurate. And they said that the reason why they reduced the redraw facility limit was because they were concerned that some customers would be falling behind on their mortgage. And so that's why they reduced the limit. But obviously, in this case, they didn't give customers any forewarning of this change that was going to occur. And as a result, certain customers have sort of fallen short in their circumstances.
Yeah, it's worth saying, John, that people need to understand that there's a difference between the loan balance that sits in the bank account and the limit on that loan account. For many mortgages, the loan balance and the loan limit, in other words, how much you can borrow, drops together, so there is no capacity to redraw. But on some types of mortgages, you have this redraw facility that allows you to effectively pull more money back out up to the pre-agreed limit. So what this particular bank did was to drop some of those limits, and it was mostly legacy loans. It was mostly loans that people had paid quite a lot off, and what they were concerned about was that in the current circumstances, people might then actually need to draw a lot more out and use the redraw facility to do that because it's cheap money, and then get into difficulty in terms of making those repayments later. So you can sort of understand there is actually some sort of logic in what ME Bank was doing. And as you say, it's perfectly legal based on the terms and conditions of the bank. But the way it was communicated was pretty shoddy. And many people got a pretty big shock because they put money into the account. The reason you do it is to drop the balance of the loan. That means you pay less interest on what's left. So it makes reasonable commercial sense at one level to an individual borrower, but it means you don't have access to the money that you thought you had, and that's what the issue was. But I have to say that generally the mainstream media reporting on this was pretty shoddy, and trying to get to the facts, I think, is really important here to understand precisely what's gone on, but also to understand that this is in the context of those terms and conditions which gives them the authority to do it.
Totally. So what I think we should do, Martin, is that so I think just on this difference between a redraw facility and an offset account, because there's a particular aspect and there's a particular risk with offset accounts that I think we're going to cover today that's quite important. But a lot of customers thought who were caught short on this, they interpreted their redraw facility as the equivalent of savings, and that's not what the situation is. So we have this slide up there. So let's put this slide. So we have on the left-hand side, well, what is a redraw facility? So basically, so imagine if a customer has a mortgage of $200,000, they have about an available deposit of $50,000. Well, if you put the $50,000 on the mortgage, well, your mortgage balance reduces to $150,000. That's how much you are left to owe the bank, and you have this redraw limit, this capacity to take the money off the mortgage by the amount of additional repayments you've made, which is the $50,000. So that's effectively what a redraw facility is. An offset account is so going on the right hand side of the slide is, so again, same situation. Customer has a mortgage balance of $200,000. an available deposit of 50,000. So rather than putting the 50,000 on the mortgage, what they do is they put that money into a separate account, which is called an offset account. So the mortgage balance stays at 200,000, but the 50,000 is in a separate account. And with this offset account, whatever interest you generate on this offset account is offset the interest you pay on the mortgage. And so that's the key difference between redraw and having an offset account.
Yes, they are, somewhat different. They have somewhat of the same purpose, because what you're trying to do is to reduce the amount of net interest that you're paying, but the mechanism is actually quite different. And in some ways, they might appear to be the same, but fundamentally they are structured extremely differently, and there are some risks and also opportunities on both. And by the way, the reason that these facilities are offered is simply because it provides more flexibility to customers, and the banks want to try and provide some flexibility and some differentiation in terms of the products that they run. The other point there is that if you then start to rely on being able to draw on your mortgage whenever you want, that is actually a little bit of a concern, because in a way, question, is that really what the mortgage is about? Now, here's the thing. Some of the account structures allow only limited numbers of withdrawals from the offset account or from the other account. So you have to be a little bit careful to understand, again, the terms and conditions about how often you can dip in and dip out. Another thing to bear in mind. But the redraw facility in particular often will have quite strong limits as to precisely how much you can redraw and when. But it depends on the lender. Some do, some don't.
Yes, and one of the important points to note that with ME Bank was the redraw facility was more available if you had a variable interest mortgage versus a fixed interest mortgage. So there was more limitations on redraw if you had a fixed interest mortgage product. So just to move on, Martin, I just want to bring up this next slide just to explain to customers at a theoretical level, well, what did ME Bank do? So just to go back to our example, so just imagine that this that the customer had 150,000 in terms of its owing balance. It had a redraw limit of 50,000. Well, what ME Bank did was to reduce that redraw limit. So just say in this theoretical example, they reduced it from 50,000 to 25,000. So they reduced it by 50%. That means that you still owe the bank 150,000, but your ability to redraw has been cut in half, and your available funds is only 25,000. And obviously, as a lot of Australians are, facing hard economic times with either their business, suffering financially or unemployment because of the lockdown, people were hoping that they could rely on these redraw limit amounts to get them through the next few months. And obviously, some customers have been shocked by the decision to reduce these redraw limit facilities.
Yes, and it's also worth saying, John, that the banks keep saying that people are well ahead with their mortgage repayments. Well,
yes,
often the reason is simply because they have money sitting either in an offset account or a redraw account. So effectively, the balance on the mortgage is lower than it would otherwise be, right? But it's a bit artificial, right? And I keep coming back to the point that the bank's claiming that 50, 60, 70% of people are ahead with their mortgages. It's all to do with these offset and redraw accounts, and it's actually masking the true position, because the expectation quite often is that people want to draw that money back out for other circumstances down the track. And so it rather over-eggs the positivity about mortgage debt and mortgage repayments in Australia from the banks.
So I'm very glad you said that, Martin, because that is one defense that I've heard consistently from the senior executives at the Reserve Bank in terms of, yes, we have high household debt, but it's not a problem, because a big chunk of those people with debt have paid, in some cases 6 to 18 months ahead on their mortgage. But like you said, if it's in a redraw facility or if it's an offset account, different circumstances or changes by bank policy could actually reduce those buffers that the Reserve Bank is banking on from a macroeconomic perspective.
Well, and also, of course, with the higher unemployment now and the lower incomes that people have, many people suddenly won't be able to make those repayments. And of course, CBA, for example, has actually now mandated all of their borrowers to pay the minimum. So they've actually taken the monthly repayments down, claiming it will actually benefit the economy. I have a feeling that's a big brotherish to my mind, and that people should have actually been given the choice to do it rather than it being imposed on them. But nevertheless, it's sort of trying to get to the point that actually saying, well, you don't have to pay more than the minimum just to keep the mortgage ahead.
Yeah. Now, so the next question then becomes is, well, did ME Bank act legally and consistent with the terms and conditions, or did they do something that customers should not have expected in any case? And so we're going to go through two. So on the weekend, I actually put a post up on social media, and I actually asked people, if you have the T's and C's for ME Bank, please send them to me. I want to read them. So a few people did. Actually, people who are in the industry who watch the show were generous to provide me some confidential documents that have been blacked out, and I was able to look at some of these T's and C's in some detail. So there's two clauses I want to pull out that I think are worthwhile to call out. Is clause 11.1. And so there's section 11 is about changes to the contract, and then there's a particular clause 11.1 which is general, and this is the quote: except as otherwise provided in the financial table, we may at any time vary any of your terms and conditions of this loan contract without obtaining your agreement. Now, Martin, I know you and I have had a conversation before we recorded this show. Now, yes, there are banks across the entire Australian economy that have get out of jail clauses in their loan contracts. But I mean, historically, I've done my banking with CUA, Credit Union Australia, and I've never seen this sort of language in my banking products, the ones that I use. I mean, these are very, very wide terms and conditions that give enormous latitude to ME Bank. And I'm just shocked that, to be honest, that anyone would sign a commercial deal with it when a counterparty says that without a term of your agreement, we're just going to change the rules of the game whenever we want.
No, but unfortunately, John, many contracts from the banks, particularly over the last couple of years, have incorporated those particular clauses or similar clauses, some more so, some less so. And in fact, if you look at contracts from 10 or 15 or 20 years ago, they were much gentler. So there's been an upping the ante here to basically give maximum wriggle room to the banks. And I think that's been encouraged a little bit, perhaps even by the regulators, but certainly by the lawyers inside the banks, to essentially give as much flexibility to the banks in uncertain times.
Yeah. I mean, look, I am probably going to write to a few people in federal parliament, because I think this is an issue that the Senate committee should actually look at. These bank contracts and whether they're actually fair or not, because I don't think they are. I mean, when you have one counterparty that has all the commercial power, and they're basically saying to the other counterparty, we can just change these T's and C's whenever we want. I mean that doesn't seem to be particularly fair.
Well, John, turn it around the other way, right? If you were making, you hand a deposit to the bank, that's a loan to them. If you were able to then turn around and say, well, actually, I'm going to, change this or change that immediately, the bank wouldn't like it, would they?
Well, I mean, so here's the thing. I mean, some people have asked me in the last 12 months, can I go to my bank and negotiate my T's and C's on my deposit account? I said, you can try. I don't think the banks will even, I think the banks will tell you to go jump. So even if you try to enter into a commercial negotiation. Now, if you're a big fish and you've got some money behind you, I mean, you have the capacity to negotiate terms. But for the average retail customer, I don't think there is any opportunity to negotiate. Now, the other important clause is clause 11.5 in these T's and C's, because the other issue was as virtue of a clause of 11.1, the reduction of the redraw limit was perfectly legal, because clause 11.1 says we can change your T's and C's whenever we want, without getting your agreement. And so that's what they did. So 11.1, so tick on that. Now, the question was it okay for ME Bank to change these redraw facility limits without giving the customer any forewarning. So this particular move about communication, and this is some of the people in the sector have said about the banking code of practice, and whether they should have told customers ahead of time so customers could have adjusted their circumstances, with a bit of forewarning. Well, the bank's T's and C's, ME Bank's T's and C's, they should cover this as well. So this is a quote: "If we, without your agreement, vary any other term or condition of this loan contract, we will give you particulars of the change in writing 30 days or more before the change. However, where such a change reduces your obligations, we will only notify you of the change before or when we send you your next statement of account after the change takes effect." When I read this clause 11.5, Martin, it seems to me that if your redraw facility limit has been reduced, that means that in theory, as well as in practice, the amount of potential liability that you have to the bank has been reduced. So, for example, if your redraw facility was 50,000, your limit, you could, back to our theoretical example, your loan balance could increase from 150 to 200,000. But if your redraw facility limit was only 25,000, you could only take up your mortgage balance up to 175,000. So this decision that ME Bank has made, to my mind, is a reduction in the obligations that the customer has to the bank, because you reduce the theoretical limit as to what the mortgage balance could be, and therefore, again, ME Bank, under these specific T's and C's, were under no obligation to tell customers before they made the decision, and because of that, this is why I think those customers who were going to the press complaining about what's happened, I think if you were to ask them, did you read your terms and conditions before you signed your contract, or even before the change, I suspect that nearly 99% or 100% of the customers who are complaining didn't actually read the T's and C's. So my view is that everything that ME Bank did was consistent with the commercial obligations, and that they acted within the letter of the contract.
Right, and I think you've just hit the nail on the head. It's within the letter of the contract, right? But you've also got to ask about, is this in the spirit of the relationship between a bank and their customer? And that's where banks in Australia fall down left, right and centre. So they are black letter followers of tick boxes in the law, but in terms of actually doing the right thing by the customer. Because in my view here, the right thing would have been to alert people that they were intending to do this, to give people a chance to adjust their affairs first. That would have been the right thing to do, but it wasn't the legally required thing to do. And there's a world of difference between those 2 points.
So the only thing with that, Martin, is that had the bank told customers that ahead of time, we're going to do this, customers would have withdrawn the money from these redraw facilities. And the bank's logic is that they're concerned that these customers are going to fall behind on their mortgage anyway. So by giving them advanced communication, it sort of defeats the purpose of, according to them, of what they were trying to achieve.
Well, I agree with that, but then you're caught back with this dilemma, right? So do you just surprise people and do it and pick up the flack afterwards, or do you actually try and deal with specific situations? And by the way, the bank has said that they will try and help individual customers if they've got a financial issue because of it. So they haven't just left them hanging. But I think it does really contrast the difference between black letter, this is what the contract says, this is what the lawyers have put together, and what I would regard as good and best practice in terms of the relationship between a bank and their customer. Unfortunately, that latter is really not very much to the fore in terms of the way that banks think about handling their customers.
Yep. Now, when I did, so I no longer have a mortgage, but when I did use a redraw facility, quite religiously. And you and I had a conversation before we started recording today as to, what were the T's and C's of my mortgage product, and was I aware of them? So, hand on heart, I couldn't recall what the contract said, but I actually read it. And so we'll just bring this up on the screen just to give some context, because there are certain banks and credit unions which are very specific about what ME Bank did. So ME Bank didn't actually have any specific references to redraw facilities in their T's and C's where they said that they're going to reduce the balance, or that they can reduce the balance whenever they want. They just had this catch-all clause to say we can change our T's and C's whenever we want, no matter no matter what you say, no matter what sort of whether we have to tell you or not. But with Credit Union Australia, I mean, this is the Section 9 other variations. This is the quote: "We may vary this loan contract to vary the minimum amount any redraw facility attached to the loan. If the variation does not increase your obligations, we will send you notification in your next statement account." So with my mortgage, because by the end of the mortgage, I had a significant sum of money paid in advance of the mortgage, and we're talking six figures. And so I had in the back of my mind that they could always reduce the redraw facility limit if there was a banking crisis or if there was a financial problem with the credit union. But obviously, in my context, they had a specific clause saying to me that they can change that redraw facility limit at any time, whereas I guess with ME Bank they didn't. But they had very loose language that could be interpreted widely, which customers didn't actually read ahead of time.
Yeah, and it's another illustration of what might look on day one an okay clause. When you actually come to look at it in detail and think about it, then sometimes they don't look at it half as good later.
And what you're describing, Martin, because I'm glad you mentioned you put it in that way. I mean, so what we do on this show is we look at legal language and we do scenario analysis. So we say, well, in today's context, this language means X, but if a different scenario was to occur, what does this language mean in that different scenario? So I think you and I do sensible scenario analysis, but our enemies in the financial media, like the AFR, call us conspiracy theorists.
Yeah, well, it's just because we can take a more balanced view than perhaps they who would champion the banks perhaps more than we would. Financial systems are important, banks are important, but people need to understand the complications dealing with the banks. And like it goes back to my point from earlier on, banks and their clauses are designed to protect them, not you.
Yeah. Now, so I just want to take the conversation to now mortgage offset accounts because this is a key point that has come up in some of the conversations I've had with a number of people over the last 12 months. So when people have asked me my view as to should people use a redraw facility or should people use a mortgage offset account, I have said use the redraw facility, and I think, and I'll obviously let you respond, Martin, but I think you've said that your preference was the offset account. But my reasoning was that with offset accounts, now again, this may vary from bank to bank, but we know that with one bank in particular, and we're just going to go through this in a second, that the offset account is considered to be a savings and transaction product, which means that it is captured under the bail-in legislation. So the example that I found was actually ANZ. So if you pick up, so in previous shows when we've quoted ANZ's terms and conditions for their deposit accounts, and to show that they can change these T's and C's if there was a particular credit event, and so we have we'll put this up on the screen. So we have clause 2.16a from ANZ, and this is obviously about they may change the T's and C's without any notice if there's to avoid it or reduce the material risk to credit risk or loss, or complying with legal or regulatory requirements. So in the ANZ T's and C's, it actually does reference offset accounts. So offset accounts in the ANZ context are a savings product, and that's obviously that obviously falls in the risk of bail-in. So what could happen in theory is if you have money in an offset account, and obviously, Martin, if I've slightly mischaracterized this, please correct me. But the way I understand this is, if you have money in an offset account and the bank is in trouble, one of two things potentially could happen. One could be is that the bank could take your money from the offset account and put it on the mortgage to reduce your mortgage balance and to reduce the risk of the bank. Or if they were to do a bail-in, what could happen is, and we've got this image on the screen now, is so before bail-in, you could have 200,000 a mortgage balance, you could have 50,000 in an offset account, and then after the bail-in, you could have, in theory, zero in your offset account, but you still may have a $200,000 mortgage balance. And so this is why I think people need to be aware of is, again, it varies bank to bank. But if you look at, what is the risk of an offset account? The risk of an offset account is bail-in because of how the terms and conditions of the bank have described an offset account.
Yeah. Now, it's very complex, this, John, because there's no legal case law in Australia relating to bail-in. It's never been applied in Australia in recent history. I know there was a case many years ago, but in recent history, right? The fact of the matter is that there is a prior right of offset that a bank has. That's banking law from the year dot, which basically says if I've got 3 accounts, 2 in credit and 1 in debit, they will always have the right of prior offset to be able to consolidate them and basically come to a net position, right? So that's right of offset almost takes precedence over anything else. If they were in the situation where you had money sitting in one account and a mortgage over there, and they took your money away to bail in the bank, I think that would be something which would be questioned in court at very least, and I'm not sure it would stand up in court, if I'm honest. But we don't know because it's never been tested. The bail-in law is, ambiguous, as we've discussed on a number of occasions, and in other countries where they've actually done bail-in, I haven't yet seen examples of where offset accounts have been stolen or otherwise consolidated. So it's an unknown. But what I would say.
No.
Go on.
Yeah, no. Yeah, so everything you said, Martin, is like I would agree with. But what we have said in previous shows is that with the risk of bail-in, well, what are they bailing in? They're going to bail in a savings product, so a deposit, a retail deposit account. And so the only point I'm making is that specifically in the case of ANZ, and a mortgage offset account is defined as a savings product. Yep. So it's basically the same sort of mechanism or deposit account that could be bailed in. But again, never happened before. But again, this is not conspiracy theory. This is scenario analysis.
Yeah, no, it's scenario analysis, and it's important to think about it, right? So in other words, if you had money in one account, if you had a mortgage over there, are you best placed to use the redraw facility to offset? Because clearly you can't get bail-in because you've got the net balance, but you've got the risk they could mess with the limits and suddenly you find that you can't pull the money out. Or do you stick it in an offset account, which means you still get the interest benefit, the netting off of that, but you then stand the risk, be it small maybe, or non-existent maybe, of deposit bail-in. So I think this shows again the precarious nature of the relationships between customers and their banks.
Totally. So Martin, to bring the show to a close, so I think it's just, again with ME Bank and what's happened with their redraw facility. So I think again it's another example of it's important that if you have a banking product, whether it's a deposit account or a mortgage, you are in a commercial relationship with the bank. You have a commercial contract with the bank, and these are the T's and C's, your terms and conditions. It's important that you read them. It's important that you actually understand what they mean in different circumstances, and that you take preemptive action so that if a adverse situation were to arise, for example, the government locking down the economy, that you are prepared financially for that sort of event, and you understand what your rights are as a customer, what the rights of the bank are, and basically you're going to mitigate any risk that you or your family may be exposed to.
No, absolutely right, John. I'll make just 2 quick points. The first is quite often when you actually take a product from a bank, they'll give the terms and conditions to you in a booklet, and they won't actually ask you to read them before you sign, right? I always say to people, you should stop at that point, get that booklet, read it, understand it, and only sign if you know what you're signing, right? That's the first point. The second is that quite often those terms and conditions may not actually be all complete. They might refer you back to websites or other sources of information. So it's not often obvious precisely what the full terms and conditions are for a particular product. So again, it's not made easy for customers to really get to understand what they're getting into. So my advice is, always be very cautious, very careful. Read those terms and conditions. I know it's a pain, a lot of words. And if you don't understand those clauses, then find somebody who can actually interpret them for you, because they are a legal contract. Once you've signed it, you're bound by it. And as we've seen in this example, it can bite you later.
Absolutely.
John, I appreciate your time today. I think this has been a very important show. And the message is to everybody, guys, read your terms and conditions.
100%.
Martin North, John Adams, in the interest of the people. We'll see you next time.